Welcome to The Explainer. Today, we're diving into Section 40, a really crucial new provision in the Income Tax Act 2025. Trust me, it's set to change the whole game for how businesses calculate the cost of their assets, especially in special cases like mergers or gifts.
So let's kick things off with a scenario you've probably faced. Imagine a company merger. Post-merger, the new combined entity decides to sell a machine that came from one of the original companies. Now, the big question is, how do you actually figure out its original cost to calculate your business profit? The question seems simple, right? But the answer, well, until now, it's been anything but.
You see, the way we answer that question is getting a massive overhaul. Under the old 1961 Act, you had to navigate this maze of very specific, narrow sections, like Section 43C. But the new 2025 Act, it streamlines everything into a single consolidated provision, Section 40. And that right there is a total game changer for clarity.
So in this explainer, we're going to break down the old challenges, introduce you to the new Section 40, walk through exactly how it works with a practical example, cover the compliance points you absolutely need to know, and then wrap it all up with the key takeaways.
First up, to really appreciate the new solution, we need to get a good handle on the problem it's trying to solve. So let's take a quick look back at the old regime.
For over 6 decades, the Income Tax Act of 1961 kind of became this patchwork of amendments and add-ons. If you were dealing with something like a merger or a gifted asset, figuring out its cost for tax purposes meant you were on a wild goose chase through multiple, scattered provisions. And this, of course, created ambiguity, a heavier compliance burden, and frankly, a whole lot more room for disputes.
And that brings us to the new, streamlined approach under the Income Tax Act 2025. This is where things get much, much simpler.
What's really fascinating here is the core philosophy behind this whole new law. You can see it right in the official guidance. The goal is to simplify and consolidate. This isn't really about changing fundamental tax policy. It's about making the tax code more logical and accessible for all of us.
And this slide really puts the scale of that simplification into perspective. I mean, just look at these numbers. We're talking about a 35% reduction in sections, another 35% reduction in rules, and an incredible 52% reduction in forms. This is not a minor tweak. It's a complete overhaul designed to make our lives easier. Section 40 perfectly captures this new philosophy in action. Its purpose is crystal clear right from the get-go. It's specifically for calculating profits and gains of business or profession. Think of it as the new one-stop shop for figuring out asset costs in all these special situations.
Okay, let's roll up our sleeves and get into the nuts and bolts of what this new section actually does.
Right. Now, the single most important thing to grasp here is the context. Section 40 is exclusively for calculating the cost of acquisition when you're dealing with profits and gains of business or profession, or PGBP. This is completely separate from how you determine costs for capital gains, which, as you know, has its own set of rules under Section 73.
The objectives behind this section are so clear. Consolidate all those scattered provisions to provide certainty, cut down on the time we spend interpreting the law, and hopefully reduce litigation. It's all about creating a predictable framework that fits neatly into the modern structure of the new 2025 Act.
Theory is great, but let's ground this in a real-world example. It'll really highlight the practical difference between the old way and the new way.
Okay, let's go back to our opening scenario. A company merges with another. A machine gets transferred over and is now considered stock in trade, which just means it's an item the new company plans to sell. So what happens when they actually sell it?
Under the 1961 Act, you would have had to specifically find and then apply Section 43C. This section laid out the rule. The cost for the new company is deemed to be the same as it was for the original company, plus any costs they incurred in the transfer. It was a very specific rule for a very specific situation.
But now, with the 2025 Act, the hunt is officially over. Section 40 consolidates everything. It creates a universal rule. For business profit calculations, the cost to the new owner is simply what the cost was for the previous owner. It's one section, one clear principle that can be applied in multiple situations.
So, what does this big shift from a fragmented approach to a consolidated one actually mean for your day-to-day compliance?
Well, this shift makes being proactive absolutely essential. The previous owner's cost is now the anchor point for everything, so keeping perfect, detailed records of that original cost is just non-negotiable. And of course, it's time to start updating your internal systems and software to reflect these new section numbers for the 2026-27 tax year and beyond.
Now here's where people are likely to trip up. The biggest trap is misapplication. Remember, Section 40 is strictly for business profits. The rules for capital gains are completely separate over in Section 73. Other common mistakes will be just using old section numbers out of habit or, and this is a big one, failing to properly document the previous owner's cost. That will definitely be a point of contention with the tax authorities.
Okay, so let's boil all of this down into 3 essential takeaways that you need to remember. Takeaway number 1, consolidation is key. Just think of Section 40 as your new one-stop shop for determining asset costs in special cases like mergers or gifts. It replaces a whole bunch of confusing old sections with one clear, unified principle.
Second, and I can't stress this enough, the scope is very specific. Section 40 applies only to business profit calculations. If you're dealing with the sale of a capital asset, you have to use the separate rules under the capital gains head. That distinction is absolutely critical to get right.
And third, documentation is paramount. The new law definitely simplifies the rule, but it does not remove your responsibility. The burden of proof to show the original owner's cost is still firmly on the taxpayer. Your records, as always, are your best defense.
We'll leave you with a final thought to chew on. Section 40 is just one example of this massive consolidation trend in the new act. So, looking at your own work, what other complex areas do you think are ripe for this kind of simplification? Because this is clearly the direction the new tax code is heading.
Thank you so much for joining us for this explainer. If you found this breakdown helpful, please do like, subscribe, and share it with your colleagues. Your support really helps us create more content just like this.
And finally, our standard disclaimer. Please remember, this content is for educational purposes only. You should always consult a professional advisor for specific guidance, as tax laws are constantly subject to change.